Welcome to The Explainer. Today, we're digging into a really fascinating story from Applied Industrial Technologies, or AIT. They just posted what looks like a fantastic quarter, but the market's reaction? Yeah, it was not what you'd expect. It's a classic Wall Street paradox, and we're going to unpack it.
Okay, let's dive right into the mystery here. On the left side, you see the results, a clear, undeniable beat. Their earnings per share, or EPS, clocked in at $2.80, which smashed estimates by about 5 to 6%. And their revenue? Over $1.2 billion, also comfortably beating what everyone was expecting. But then, look at the right side. The reaction was a nearly 4% drop in the stock before the market even opened. So, what gives?
And that right there is the big question we're going to answer. You know, the headline numbers look fantastic, but investors, well, they get paid to read the fine print, to look for the story behind the story. And we're going to find out exactly what they saw.
But hang on. Before we solve the mystery, we really need to get a handle on just how good these results were on the surface. Because when you understand all the good news, the market's negative reaction becomes even more puzzling, even more interesting.
First up, let's just talk about the wins. Earnings per share hit $2.80. That beat their own top-end guidance by almost 5%. That's a big deal.
Then you've got the revenue, which grew a solid 5.5% to about $1.2 billion. Again, another really clear beat against what all the analysts were predicting. And to top it all off, look at this. They generated a record-breaking $465 million in free cash flow for the year. That's up a massive 34%. You know, that's the cash a company uses to pay dividends, buy back stock, basically reward shareholders. And AIT was absolutely swimming in it. So let's recap real quick. They beat on earnings, they beat on revenue, and they generated a record amount of cash. I mean, by all accounts, just a stellar performance. Okay, now it's time to put on our detective hats and start looking for the clues hidden deep inside that report.
All right, this is where we start reading between the lines. Because the story the market actually reacted to wasn't about the amazing quarter that just happened. No, it was all about the uncertain quarters that are yet to come.
And the very first clue was right there in the company's guidance for the next fiscal year. Now, the numbers themselves, they look okay at first glance, but management used a key word to describe their outlook, prudent. They cited ongoing economic uncertainty. That one word, prudent, it's like a code word for caution, and it signals to Wall Street that there might be slowdowns ahead. For an investor, that's an immediate yellow flag.
Okay, the second clue is a little bit of accounting jargon that popped up in the report, LIFO noise. It's a weird term, but it pointed directly at some pressure on the company's profitability. So let's break down what this actually means, nice and simple.
So LIFO just stands for last in, first out. It's a way companies account for their inventory. The easiest way to think about it is like a stack of plates. The last plate you put on top is the first one you're going to take off. LIFO noise is what happens when changes in your inventory costs start to create these little distortions that can make your profit margins look better, or in this case, a little worse than they really are. And here's exactly how that noise, plus a few other things, hit the numbers. There was a $2.9 million LIFO expense that made for a tough year-over-year comparison. Then you add another $4 million hit because they had to set aside more money for potential bad debt, plus higher compensation costs. And what's the result of all that? Their EBITAL margin, which is a super important measure of profitability, fell by 73 basis points. Investors absolutely hate seeing margins get squeezed like that.
Now, digging even deeper, we find another really important detail hiding in their two main business segments. You see their higher tech engineered solutions part? It grew, but just modestly. But their core service center business, which is a huge part of what they do, actually saw its sales decline a little bit. This split, this divergence, it signaled some real underlying softness.
Okay, so now we get it. We understand the market's short-term fears, right? Cautious guidance, pressure on the margins, and some softness in a core business. But that is not the whole story. Let's zoom out and look at AIE's long-term strategy, because that puts all of this bad news into a completely different context. This quote here from the CEO, Neil Shrimpsher, really sums up the company's point of view. You can see that despite the market getting all jittery, management is basically signaling confidence. They're saying, hey, we believe we're building a more resilient company, and we have a very clear plan to get it done.
And here is that plan, right here in a nutshell. First, they are on an acquisition spree, buying up companies like Hydrodyne to basically buy growth. Second, they're laser-focused on high-growth tech areas like data centers and automation, which happen to be the exact areas that are doing really well. And third, they're using their strong market position to raise prices.
It's this three-part strategy to pivot the whole company toward higher margin, more resilient businesses. And you know what? This strategy is already showing results. That Hydrodyne acquisition I just mentioned, in its very first full quarter with the company, it already kicked in over $7 million in EBITDA. That's a real, tangible sign that their M&A plan is actually working.
So, here we are. We have the market's short-term fears on one side and the company's long-term strategy on the other. So what's the big lesson here? What does this whole story really teach us about how to look at an earnings report? Well, it all comes down to this one simple, powerful truth. The stock market is a forward-looking machine. It doesn't price a company based on what it did last quarter. It prices a company based on what it thinks it's going to do over the next several quarters, and even years into the future.
So to put it all together, here are the key things you should take away from this. First, a great quarter is just history. It's the future guidance that is absolutely critical. Second, all those noisy little details hiding in the margins, that's often where the real risks are hiding in plain sight. And finally, remember that a company's smart, long-term strategy can sometimes be completely at odds with what the market wants to see right now in the short term.
And that leaves us with one final provocative question to think about. In this case, with AIT, was the market's cautious reaction the right call, focusing on those immediate headwinds? Or did the market just miss the bigger picture, maybe even creating a long-term opportunity in disguise? That, my friends, is the billion-dollar question that every investor now has to answer for themselves.